Good morning, everyone, and welcome to today's seminar. I will start recording. This is a recorded meeting that will be posted on the IEO's website early next week in case you want to see it again or share it with colleagues. To ensure sound quality, I'd like to ask everyone to make sure you stay muted unless you're speaking. And after the presentation, we will have a time for general discussion where you can ask questions or make comments. And the chat function will be open during the speaker's presentation. You can put your question in the chat at any time. We'll address all the questions during the discussion time. Alternatively, at the end of the presentation, you can raise your virtual hand and come in with questions at that time. So it's now my great pleasure on this sunny Friday morning in Washington and evening in Paris to introduce our distinguished guest speaker. We're honored to have Professor Helene Monnet here today. He will be speaking on the dominant reserve currency role of the dollar and upcoming challenges. Professor Helene Monnet is Director of Studies at the École des Hautes Études en Sciences Sociales, EHESS, professor at the Paris School of Economics. He's a member of the CEPR, the Center for Economic Policy Research, and a scientific advisor at the prominent French think tank, the CEPI. He was an economist at the Banque de France, the Central Bank of France, from 2013 to 2019. He has published numerous articles on the history of the international monetary system, public debt, banking crises, financial markets, and the financing of long-term investment in France and Europe in the 20th century. Professor Monnet's work also focuses on the history and the current issues of central bank policies. His research in economic history has won awards from the Economic History Association, as well as SUERF Unicredit, among others. And in 2021, he was awarded the prize for the best young French economist by Le Monde Cercle des Économistes. His recent books include, in 2015, Euro les années critiques, followed in 2018 by Controlling Credit, Central Banking, and the Planned Economy in Post-War France. Just last year, he published L'Europe, une puissance publique, and Balance of Power, Central Banks, and the Fate of Democracies. So congratulations on all these recent publications, Eric. Today, in the seminar today, Professor Monnet will explore three critical dimensions of the dollar's dominance and its potential vulnerabilities. The first dimension pertains to the historical foundations of the US dollar's entrenched role in trade, finance, and reserves that was only matched by the British pound back in the days. Second dimension is the changes in that current situation, shifting dynamics of foreign holdings of US debt, a trend that coincided with a surge in foreign reserves driven by emerging markets in the 2000s, starting in the 2000s, which may be reducing structural support for the dollar. And a third dimension, and one that's a particular focus of this seminar, are newer future challenges, the potential impact of dollar-pegged stablecoins and risks of digital dollarization, as well as the European Union's regulatory response, including through its regulation on markets in crypto assets for issuance of and dealing in crypto assets. Let's, without further ado, because I know that you have a lot of material to cover, Professor Helene Monnet, let's give you a warm welcome and start your presentation. The floor is yours.
Thank you very much, Hélène, for the nice introduction and most of all for the invitation. So I'm very glad to talk about on this issue today. Just as an important caveat, I mean, what I'm going to present is not based on an original research paper. It's more a set of remarks which are based on several writing or research projects I'm currently working on, and I'm also including a recent report that I've just written for the European Parliament, and which have been posted online, I think only two days ago. So these are a set of remarks, but I think we will all agree that this is a topic if we want to discuss the challenges ahead and the future of the dollar, where it is very, very difficult to do some kind of clear forecast. So there will be a lot of uncertainty when I'm going, but at least what my goal here is to to set some, I mean, not to emphasize some important points, which I think are really new in the way we should discuss the issue of the dollar as a reserve currency in the years to come. And I think as someone who usually have a historical perspective, I think it's very important to emphasize that there are some new characteristics today that even the historical background is not so useful to forecast or to plan what is going to happen. So I'm going to share my slides and start here. So I mean, starting with the basics, I mean, we all know that the dominance of a currency has historically been the product of several factors, including like being a very strong geopolitical power, often also military power. Second, financial dominance, meaning like having assets that are highly traded on financial markets, international markets, and also the ability to have a financial center like London and New York, where you have a lot of financial transactions and an ability also for the country to do a lot of direct lendings to other country. And third, also the having a open capital account and the ability to provide a safe assets. And as we all know, I mean, at least in the recent history, which is the only times where there have been such a big financial globalization in the world, only the currency of the United Kingdom, pound sterling, and then the US, the dollar, have made this criteria in history. So you had many other currencies that have tried to compete with these other two, but none of them really managed to meet all these criteria and to become the dominant currency. I mean, the typical example, which are often discussed, are the Japanese yen. That's really missed to have a strong enough financial center, and especially to have a strong geopolitical power that will rival with the United States. And China today, and it has been discussed a lot, and I will come back to that, lack the ability of having an open capital account and provide a safe asset to the rest of the world. So, I mean, these are the criteria for being like the dominant currency. I mean, the one that really is stronger than the other one, but some things that have been emphasized in a lot of research and historical research, most of it has been conducted by or under supervision of Barry Eichengreen. Even if there is only one dominant currency, there can be many other which are sizable reserve currency in the world. And today we have the euro, which is, I mean, more than 20% of the reserve in the world, so it's not negligible. And in the past, if you go back to the classical gold standard before World War I, Germany and France also had their currency, which was highly held by all the central banks. We also had sterling that at the time of domination of the dollar after World War II also became a second currency. So we know that multiple reserve currency is possible and has existed in the world. So when we talk about domination of a reserve currency, it's always important to think that the second and the third can also play a role. So these are just like simple background, but just a reminder that what matter if geopolitics, international financial markets matter a lot in this respect. And so the questions that naturally follow from the basic I just reminded at the beginning of this presentation is that the current shift in geopolitics and potentially in international finance that we see happening, although it's still quite very difficult to give sense, to make sense of them, are surely going to affect this balance of power among reserve currency in the world, which raises the question of whether the domination of the dollar is threatened. And as I said at the beginning, these responses can only be highly prospective. But I try to give some hints on how to try to talk about this issue and to make sense of this, and then I will make mostly three main arguments, which are based on recent research projects or publications. So the first one that I will emphasize is actually one of the issues we currently have in thinking about this problem is that we still remind the early 2000s, so the start of the 21st century, and we tend to view these times, which actually it was almost only one decade, as a norm. And actually it was more an exception than the norm, especially for the way that there was a very, very high demand for US public debt driven by a very sharp rise in demand for official reserves, and also important change in financial liberalization that led a lot of countries to prefer to accumulate foreign reserve in the form of securities rather than other deposits or non-marketable claims. So I think it's very important to start from this because it gives a way to understand why the US today is not at all in the same situation that it was in 2010, that even if the share of the dollar in total reserve currency is the same or about the same as 10 or 15 years ago, it has decreased only a little bit. I mean, the demand for reserve asset has changed a lot, and I think it's an important starting point. The second one, which I will probably discuss much more briefly, and it's based on the paper that was published last year with Barry Kengrin, Camille Macker, Arnaud Mel, Alain Neff, which is on the Chinese renminbi and whether it can rival with the dollar, which is clearly not the case today. And the main argument we are making here in this article is that even though, I mean, to become dominant currency, capital account convertibility is needed, it might not be needed for being like a second or third important currency. So it's something, again, to take into account that if we talk about a multiple currency, reserve currency world, it's not given that capital account is something that is absolutely necessary. And the last point I will make, which is based on the report that I just mentioned at the beginning of the talk, which has just been published and will be a basis for discussion around the monetary dialogue between the European Central Bank and the European Parliament that will happen on Monday, so next Monday, which is about the new strategy of the US to promote dollar-pegged stablecoins and how this can be a huge game changer for the US, of course, but also for other countries and also for the international monetary system. So I will basically hear what is happening that and I'm sure a lot of you are aware of this, is that the US is trying to promote stablecoins to ensure the dominance of the dollar as a reserve currency in the world. So is it going to work? How other countries are going to respond to this? I think these are questions that are really, really key to talk about the future of the dollar and the future of international monetary system today. And this is probably what I will emphasize more in this talk because I think it's extremely important. So the first point on which I will be quite brief. Just a reminder that today, I mean, although there have been ongoing discussions for almost forever on whether the dollar could be challenged as dominant currency, it's clearly not happening. I mean, you can see that in the number of pegs, the number of countries which are pegged to other currency, and today there's still most countries pegged to the dollar than to any other currency in the world. So it's more like 50%. It's the same if you look at the total of official reserves. You see here that this graph, which is from using very standard IMF data, and the share of US dollars or official reserves is in blue. And although there have been a slight decrease by almost from 70% to 60% in the last 20 years, we see clearly that the dollar has not been really challenged as the main reserve currency in the world. So this is not really new. What is, I think, a bit less well known. I mean, no, sorry. I mean, this is also the other graph is also something which is quite well known, but I think it's important to recap again. If that's there in the early 21st century, after the financial crisis, that hit many emerging markets or fast Asian economy in the late 1990s, the demand for reserves are really increased in ways that are clearly unprecedented in the history of the world. So if you look only at the graph on the right panel, which is just this reserves shared by GDP, which is a new data set that we are compiling currently with my colleagues at the CEPI, where we gather a lot of data on central bank balance sheet, which includes some reserves, and you see that there have been a huge increase in share of GDP. Which was clearly unprecedented and happened in the early 2000s, which was true for many countries, but including mostly for emerging markets in middle income countries. What is less known is that this huge increase in foreign reserves, in demand for foreign reserves, which have been identified a lot, is that it was linked to a large change in the composition of this foreign exchange reserve, which is really a shift from deposits to securities. I mean, you know that foreign exchange reserve can be held in many ways, but the two main ones are the deposits of securities. And so a sizable amount of them are just like deposits in foreign banks that can be either private banks or central banks. All of these reserves can also be held as securities, and partly because of globalization, partly so there was more. It was an easier access to securities in the world, but also partly because there was a big demand increase in the demand of foreign reserves. So a lot of countries decided to invest in that more in assets that earn an interest. There was a big shift toward securities in the early 2000s, which was linked to this more general increase for reserves. So the consequence of this is that actually there was much more country which were ready to invest a lot in the securities issued by the dominant reserve issuer, which was obviously the US, which means that is in the early 2000s, the share of US public debt held by foreign official reserve holders, I mean, mostly central banks in the rest of the world, really jumped in an amount which have again never been seen before. So this is the blue part in the middle of the graph here, and you see that before about 10% on average, sometimes close to 15% of US public debt were held by foreign central banks. But in the early 2000s and until the 2010s, this amount was really doubled, and it was almost 30% at some point of the US public debt, which was held by foreign central banks. So this was really some kind of major shift in the composition of the US public debt, and this shift has been reversed since starting around 2015 for two reasons. First, because the US public debt increased a lot after the fiscal stimulus of the 2010 and then COVID, and then because we see that the demand for foreign reserve has stagnated as a share of GDP. So there was less overall demand, less growth in the demand of foreign reserve, and increasing foreign debt. So now we end up with coming back to a more normal state of the world where almost 10% or only, let's say only 10 to 15% of the US public debt is held as foreign reserves in the world. So for the US, it's a sizable issue. I mean, it's a sizable issue that actually the share, I mean, the demand for the US debt by these foreign official holders has quite decreased and represented a less important share of their public debt. I'm going to skip that. But I think that what we get from this graph, which again I emphasize is part of a current project that we're doing with colleagues at the CP on the evolution of central banks and the international money systems in the 1950s, is that the current context, let's say the last 10 years, have been much less favorable for the US public debt as a reserve currency in the world. Okay, which does not imply that there was a fall in the share of dollars as reserve currency. So these two things are very different. I mean, whether you just looking at the total composition of official reserves in the world, or if you see the issue from the point of view of the US as a reserve issuer. But so this raising an important question. I mean, for the US today, I mean, can the US count on an increase of demand, a new increase of demand or not? And I think these are quite shaped a lot of debate in the US recently, to which I will come back. So given the time now, I will be very brief on the second part of this presentation, where I just wanted to summarize some of the main arguments that we developed in this article on the internationalization of the renminbi. The main point I want to take from this article, which contains a lot of details on Chinese currency internalization, is the fact that the internationalization of Chinese renminbi has been tried to follow a model which, as we know, is very different from the one followed in history by the pound sterling and then the US dollars. So this model, which relies much more on bilateral lending than having a capital account convertibility and providing a safe asset, has been dismissed by many economists as saying, okay, this is clearly not the right model to become a dominant currency. And it's true that for the moment, I mean, the renminbi only, reached 3% of total reserve assets. So it's not, in that sense, from this point of view, it's not a success. But what we did in this paper is to say that, if you look broader at history, and if you look also at the details of Chinese currency internalization, actually this model will never, I mean, probably not push the renminbi as a dominant currency, but can still push the renminbi to be an important currency, much with a share of total reserve currency much higher than what it is today. So the main point is that you don't need to have if your goal is not to become the first dominant currency, but maybe the second or the third, capital account convertibility is not necessary, as long as you can provide your currency through bilateral lending, so swap line and loan, what the Chinese central bank has been doing, and that also you have what we call in the paper a safety valve, meaning that if you have countries which are not only benefiting from this bilateral lending, but still want to invest a little bit in their currency, you need to be sure that they can still exchange this currency against another on the free market, which in the Chinese case is Hong Kong, where the Chinese central bank has been intervening, which means that actually we could imagine a part of the world, a state of the world where the Chinese currency will become more important as a reserve currency, but still need to hold some dollars. But what is important in this story, and I will emphasize that I won't have time to go in the historical example because we think it's not completely new, but we can go back to that in the Q&A if you like. Is that China has been pushing for more geopolitical approach to this reserve currency, which again is not completely new in the world, but in some way has been pushing the US, we think, to also think about these issues, about having maybe a more bilateral approach to how you can provide reserve currency to the rest of the world. So because of the two features I've emphasized at the beginning of its presentation, the US was in this is still today in this in situation that if they want the domination of the dollar to continue, either they should try to rival with their Chinese strategy that has been using a lot of bilateral agreements to push for currency internalization, or they should find an alternative demand for US debt, because what happened in the early 2000s is not, I mean, has stopped and is not happening again. And so the US policy, I mean, in some ways, I mean, these two characteristics, I think explained quite well the state of the debate that was in the late 2024 and at the beginning of this year, 2025, in the US administrations, where you had more people like Stefan Miran, for example, pushing more for the first solution and linking more the policy of the dollar to bilateral agreements. That was the famous but not happening Mar-a-Lago agreements or Mar-a-Lago Accord, for example, or some of pressure on some emerging market to keep their reserves in dollars. So that's one solution. And then you have another solution, which have also been favored by the Trump administration. And for the moment, I think the second solution is winning among the US administration, is to find an alternative demand for US debt. So what can be this alternative demand if it's not foreign central bank? And this is where the issue of stable coins are coming in. So here the picture are just like copy paste of two pieces I wrote recently on this issue. So one first was for the SWERF, which is as you know is an important organization for discussion on central banks, and the second one is this report co-authored with Jens van Kloster and Eduardo Martino for the European Parliament. And as I said at the beginning, this will be discussed with an exchanges between the European Parliament and Christine Lagarde on Monday. So if you're really interested on this issue, you can watch at 2 p.m. on Monday this online discussion between the European Parliament and the ECB, where they will discuss, I think, quite a lot how this new US policy to promote the domination of the dollar through stablecoin is a challenge for the euro, for the euro area itself, but also for the international role of the euro. So if you're, I think many of you might be already aware of this, but if you're not completely familiar with the debates that had happened in the US in the beginning of the year, you can read these two quotes. The first one is from a executive order by President Trump signed on January 25, which explicitly said that the US should take action to promote the development and growth of a legitimate dollar-backed stablecoin worldwide. And the second has been just a speech by Treasury Secretary Scott Bessent saying that the US should keep the US keep the US dollar, sorry, as a dominant reserve currency, and the US aims at using stable coins to do that. So stable coins are private currency, which is issued by private companies, and which are stable in the sense that they are fixed to another currency, a more established reserve currency, or a basket or other currencies. So today, most of the stable coins are pegged to the dollar, although they don't need to be, but this is the state of the world, and it's likely to remain so. So basically, a stable coin like USDT or USD1 today are just like their value is just $1. And for this currency to be credible and to be accepted, then the issuer needs to have assets so that the customers, I mean the users of the currency, know that they can convert this stable coin into a more established currency backed by these assets if they need. So typically, if you at some point you do not trust anymore, you don't need anymore the USDT, the stable coin, you can convert them back into dollars. So the whole issue is whether these issuers are credible enough, and so that's why a lot of what's happening now is to push for regulation so that people can use this stablecoin to have more safety. And this is what the US has been pushing recently with a Genius Act discussed in Congress. So with several other people, we have called this policy of pushing stablecoin, which is a cryptocurrency, a form of cryptocurrency, to push for the domination of the dollar, which is explicitly said by the Trump administration. We have use the term crypto mercantilism, which is this idea that actually, there's a big, pushing the power, pushing the dominance of a country through this cryptocurrency. So. And this is not only the US administration. I mean, there is a report which has been circulated a lot, so you might have seen it. It was written by Citibank, and Citibank has done forecast and they say, so I think this should be taken with a grain of salt, obviously, but so it's not to make you think that these forecasts are exact, prediction are exact, but more to show you that this has not only the US administration, but also private actors, private financial actors are also trying to integrate this in their discussion and business strategies. And this report by Citibank expect that actually the amount of US treasuries in 2030, so it's only in 5 years from now. I mean, this will exceed the amount of US debt held by any jurisdiction in the world. For example, Japan is the largest holder, and so the total amount of US debt held by stablecoins. And to remind you, I mean, what the stablecoin issuer needs to hold US debt is to back the currency that they issue. So if we believe this expectation of both private financial actors and the US administration, that should not be a minor shift for the international financial system, monetary system, and also for the financing of US debt. So something we discuss a lot in this report, we try to assess the potential risk of the stablecoin. So we do it for the EU because it's a report for the European Parliament, but I think a lot of this matter also for other countries. So what are the risks of stablecoins? The first one, which have been discussed extensively and extensively in the economic literature, is just like stablecoin actually might be risky. If they are not regulated strongly, where users can know exactly what are the assets backing the stablecoin, they can be risky, and you can have like bank run on stablecoin. That also actually stablecoin, if they are not run themselves, can create bank runs, because they can push depositors to withdraw their money from banks to put them in stablecoin, and so you can have a lot of flow and shift between stablecoin and other more stable form of money. So these are an important risk which are well known, well discussed, but these are general to stablecoins and not linked to dollar peg stablecoins per se. The second risk, which is very different in nature, is for other countries, which is not the US country, because the first risk can apply to stablecoin in the US. Is that actually you can have a kind of digital dollarization of this other country. I mean, the typical example is that if you think about any big tech company, so we can that can somewhere start to ask the customers to open a wallet with a stable coin to pay or to transfer money. And people are using this, and they might actually use, instead of using payment in their domestic currency, they will use now payments in dollar peg stable coins. So at the end, I mean, they are basically using something which is pegged to the dollar, so they can be subject, I mean, the household and company using them, they can be subject to exchange rate risk. I mean, so that if there is an appreciation of the dollar and they want to convert their money back into their domestic currency, that might be a risk, which can be, for appreciation of depreciation. So it can be in the two direction, but that can be not fully anticipated by the private actor, especially households. And so, like any kind of dollarization, it can be a constraint. I mean, if this becomes sizable, this can be a strong constraint for domestic monetary policy. So these are some things that can be true for any kind of country, obviously not only for the euro area. And but then for the euro area, since there is this very clear now objective of having an international role for the euro that have been restated by Christine Lagarde in an op-ed this week, it will mean that actually if many other countries, even if the euro area don't adopt a lot these dollar peg stable coins, then if other countries do, I mean, all these dreams of the current dreams of the European central banks of pushing the euro of international currency will be really, I mean, limited. I mean, we'll have to face the fact that dollar peg stablecoins circulate widely. So we assess this risk in the report. I'm not going to go into all the details because this risk, of course, need to. I mean, there are many different ways to assess them in trying to make some scenarios of what kind of users can use these stable coins or not. But something also we emphasize a lot in the report, and this is why one of the three authors is a lawyer, Eduardo Martino, that to assess this risk, you really need a good comment of the legal framework. So it's really key in each jurisdiction, to understand how these stablecoins are regulated. And so it's true in one country, but it's also true in the country where the stable coins are most likely to be issued, which in the case of dollar peg stable coins might be the US. So this is why a lot of the report focus on a very detailed legal analysis and the comparisons between the regulation of stable coins, which has not yet been passed in the US, is still discussed in the US Congress. It's called Genius Act. And on the other hand, the current regulation of stablecoins in the EU, which is called MiCAR. So something we emphasize in the report is that there is a huge difference between the two approaches of the European approaches and the US approaches to stablecoin regulation. So the EU approach, which have predated, I mean, anticipated all what we are talking about today. So it was developed a few years ago. As main objective is to have very low financial stability risk of stablecoin. So stablecoin can be issued in euro and circulate in Europe, but it's very constraining for the issuers because all the point of the MiCA regulation is to make these stablecoins very, very safe, and to be sure that users that use stablecoins can really recover their money if they want. So the Genius Act, on the contrary, has two objectives. The first one is to make the stablecoin safe enough so that people want to use it. But on the other hand, it's also to make the regulation flexible enough so that the US hope that there will be as much as a stablecoin issuer as possible, so that this dollar-pegged stablecoin can circulate very widely. So I can only give some example here, but if you're interested, you can dive into the long appendix of the report that you can find online, where we have and it's Eduardo that made all this, not me, because my proficiency in law is quite limited, as you can guess. But we have a very detailed comparison of the two legal framework. And a few examples which I think are telling is, first, in the US, it's just like one size fits all. So even if you're a small issuer, a big issuer, the regulation is exactly the same. While in the EU, there are really special regimes for significant issuers, meaning like issuers that will be deemed as significant. So then we have a more capital and liquidity requirement. The other thing is that in terms of assets, the assets that are here to back stablecoins, so the EU also force stablecoin issuer to have very safe assets and also very liquid assets, so that even like 30% of these assets may actually be deposited in other bank accounts, which is very safe, but also like create a connections between the banking system and stablecoin, which can be good or bad. I mean, we can discuss that later. While the US, allow for a very, very wide range of potential reserve asset from money market fund, banks, and other very liquid securities. So it's much wider. Then you have a lot also of important point in Genius Act. I mean, as it is written and proposed recently, because as I said, it's not been passed, so that the US Secretary of Treasury can take decision to facilitate the internal transaction with the stablecoin and with interoperability with other jurisdictions. So the idea here is to have a push from the administration to be sure the stablecoins are going to be used worldwide. While in the EU, I mean, there's clearly none of this. So that actually there is nothing which facilitate the use of the EU, the stablecoin issued in the EU to be used outside of the EU. And last, something which is very important, which has been, I mean, very overlooked in the recent discussion in the EU, is that actually the ECB can issue a binding opinion and force the European Banking Authority to stop the issuance of stablecoins if the stablecoins are denominated in non-euro currency, which typically will be the dollar. So it means that currently there is already something in the EU legislation, so that if at some point a stablecoin, which is a dollar-pegged stablecoin, and that becomes so big and will look like a kind of dollarization of the European, will imply a kind of dollarization of the European economy, actually the ECB can stop that. So it's very restrictive, and it's very binding. So one conclusion of this is that actually in the euro currently, the risk that people will suddenly turn to using a dollar-pegged stablecoin, and that we will go to a kind of quasi dollarization of the European economy through this dollar-pegged stablecoin, is very unlikely to exist. First, because the regulation already gives the power to the European Banking Authority and the ECB to stop that, to have that. But also for other reasons on which I will be very brief, but are discussed widely in the paper, that actually the basic message is that since Europeans always have access to bank accounts, the euro is still a very stable currency. So in this kind of context, I mean, the incentives for Europeans to shift to stable coins are quite limited. And even if they shift a little bit for regular payment, this is not going to be a huge shock for the banking system or for the total deposit in the euro area. But our main point is that actually this might be very, very different in emerging markets, where a lot of people actually don't have a bank account. I mean, in many countries in the world, less than 30. Sorry, it's just like more than 60 or 70% only of the population has a bank account. So in that case, you can imagine some people will shift immediately from using cash as a regular way of savings and payments to stablecoin. And this is especially the case if these economies have unstable currency, having inflation, which in that case, using dollar-pegged stablecoin is a hedge is a way to hedge the risk of inflation. So it's like, getting some US dollar banknotes, but in that case, it's clearly much easier to subscribe stablecoin if there is no regulation that halts this. So, and especially again in country where there is a high level of remittances that people already pay are used to pay by phone digital payments, that could go quite quickly. So this is really the risk we emphasize, which is a risk for this other country, which again, it's a risk which is limited in the euro area, but might be true for other country to have this kind of quasi-dollarization through stablecoins, which can be a threat for their monetary sovereignty and also possibly for financial stability, because given the Genius Act, it's not clear that all US issued stablecoin will be very safe. And then for the euro area, I mean, it's not maybe, I mean, just like all for this European Parliament, we have to talk about this. But if you go back to the euro area, this can be really an issue for the international role of the euro, because the US plan might work in, pushing for the dollar, the dominance of the dollar through these stable coins. So what are the choice of other country now? I mean, so either we'll say there will be a competition between stable coins, or either all other countries are going to issue, to push for the issuance of stable coin, which will be as risky as the US one in order to have a lot of competition. So this is one possibility, which we assess as very risky in the report, not only risky in terms of financial stability, but also risky in terms of business model, because of the domination of the US big tech in the world, in social network, in a retail store like Amazon and so on. I think there's a very big advantage in terms of incumbency. So the other way that we promote, and that are always been discussed by international organizations like the IMF, of course, and the BIS, is to promote a kind of what we call payment multilateralism, where actually other countries can organize themselves and be sure that payments between countries will be faster, more secure, and easier than there is today, so that people do not need to rely only on stablecoin if they want to transfer money from one country to other, for example, for remittances, without going through institutions which take high fees. So we think this has become, I think, a very key issue for the future of the international monetary system today, is how much other countries are going to be able to organize to build this kind of payment multilateralism, which in other words means interoperability between their central bank digital currency, but also it can be like private or government supported fast payment system, which I think we can go back into the discussion, but I think it's really one of the key issue for the international payment system today, which will in many ways influence a lot whether the US will remain the dominant currency or will even become, more dominant reserve currency if the plan of the current US administration were to work. So in conclusion, I think what is, as I said many times already in this talk, I think the recent US promotion of stablecoins is here to replace falling demand in official reserve held in US dollars. So it's in some way it's a response to that. It's very explicit that the goal is to maintain the dominance in the dollar through this privately issued currency, which is a way also to find a way to manage to hold public debt by issuers which are not official issuers like central bank in the world. And so in any kind of discussion that we have today about the future of the dollar and the future of the international monetary system, this issue of stable coins and how other countries are going to react to the current US policy, I think is absolutely key. Thank you very much, and happy to go back to all this part and discuss that further.
Thank you, Eric. Fantastic, very thought-provoking presentation. Thanks so much. We are now going to begin the general discussion portion. And as a reminder, if you'd like to ask a question or comment, you can either put your question or comment in the chat, or you raise your virtual hand and I will ask you to unmute. The floor is open for any questions or comments. And and actually I have one to get us started. I was curious, Eric, what is your view on where does this leave us in the end? Are we going towards, and you hinted at that in your conclusion, are we going towards a system that will entrench even more the dominance of the dollar, this digital dollarization that you underline? Or will it actually accelerate the fragmentation in the international monetary system? And I think this is something you call payment multilateralism. I know that it's very prospective and early, but I was wondering what's your view on where things are heading in the end?
Yeah, so I mean, payment multilateralism is not fragmentation. I mean, it's on the contrary, it's making bridges. But in principle, it's not fragmentation. But then it can be fragmentation is, this multilateralism is not full multilateralism. So that actually it's more kind of regionalism, that actually this arrangement between fast payment system or digital central bank currency may happen mostly at the regional level or between different groups. So it's not, in principle, it's not fragmentation, but I agree that it can be. And this goes back to your first question. It can be depending on the reaction of central banks and how central banks and regulators worldwide are going to react to this US policy. So that's why I emphasize it's really key that, and we don't know currently, but the reactions can be of several forms. I mean, they can be of creating central bank digital currency, but again, if it's only the creation of central bank digital currency without interoperability, so it's not going to diminish the use of stablecoin if stablecoin are really used to be used for international payments. And the second thing is really regulation. So I think that's going to be really the key, and it's very different. I mean, and country may have, we don't know yet, but they may have very different strategies playing on these different legs, which might be central bank digital currency and regulation. So some country will actually, as I said, try to have regulation which is very flexible and try to compete with the US in trying to issue stable coins against the US or other country, which, for example, China is doing today, which is really, blocking kind of all stablecoin regulations, or the European Union, which make circulation of stablecoin only for very, very safe stablecoins. So that's what is going to matter. And that's why, depending on this reaction, that will shape the future. And for the moment, it's very difficult to know exactly where the majority of the country are going to go.
Excellent. Yeah, the stark differences in approaches for sure. I see a question in the chat by Erin, so I'll read it for you all. Thank you for this very interesting presentation. I saw that you had a bullet about how the stagnation or reduction of demand for US dollar assets from official holders wouldn't necessarily change the share of dollar reserves held by official holders. And Erin asks, Eric, if you could please elaborate on that.
Yeah, I mean, if we're just to distinguish, I mean, the two approach I was taking at the beginning, because it's always the same. I mean, like for any kind of financial asset, you can take it from the point of view of the asset holder, of the point of view of the issuer. And so what you see in the point of view of the issuer, so I mean the share of US debt held by foreign official as foreign official reserves in the balance sheet of the US might not be completely related to what we see as a share of US dollars in the asset of central banks worldwide. So, I mean, we had, and what we have seen is that there was a big decrease. I mean, a big decrease in the share of US public debt held as official foreign reserves. But it does not mean that the dollar the share of the dollar as foreign reserves in central banks' balance sheets has decreased over time. So I was just reminding that these are two different things, and what makes it different is the competition. Is a competition of other currencies. So that's why there was this link with what China were going to do, and most and earlier with what the EU is going to do. But I think what is interesting is that my view, I mean, we might say it's provoking, I don't know, but is that because of what happened in the early years of the 21st century, many people have started to equate the two, where we have decided that actually the dominance of the dollar in the world meant a large share of US public debt held by other central banks. And what we realized in the recent years is that it's not, these are different things. Okay. And the realization that these are different things, I think has ring some bells among economists, but also in the US administration, that actually the dominance of the dollar does not necessarily imply that the high share of US public debt will be held as foreign reserves.
Yeah, it's super interesting. And also your talks, you mentioned this paper with Barry Eichengreen on how the Chinese renminbi is inventing a new way to become a second reserve currency that's not following the traditional model. So there's all sorts of ways to be held by central banks.
It's funnier to try to have dissenting views. I mean, it's always more challenging. So
yeah.
try.
We have a couple more questions in the chat. So actually 3 more questions. So I'll go through one by one. N is asking, is thanking Eric for this very interesting talk. And the question is, for emerging markets and low-income countries, the increasing adoption of dollar-based stablecoins presents a complex set of challenges and potential benefits. Given that these stablecoins can significantly exacerbate dollarization and thereby undermine the effectiveness of independent monetary policy and potentially affect domestic money supply, question is, what are the most critical policy trade-offs that central banks in emerging markets and low-income countries face? And furthermore, to what extent might the perceived threat of stablecoin-driven dollarization accelerate the strategic shift towards national central bank digital currencies, not merely as a defensive measure, but as a tool to reclaim monetary sovereignty and promote financial inclusion?
Yeah, so I mean, digital currency, I mean, within a country and also as a mean of payment internationally through interoperability is a way to respond to one reason to hold stablecoin, which is like easiness of payment. I mean, making easy payments with low fees. So indeed, I mean, if country provide a CBDC and also make sure that all fast payment system and make sure they're it can be used for international payments, that's a way to provide to people an alternative to stablecoin. Then there is another reason to hold stablecoin, especially dollar-backed stablecoin, is as a hedge against inflation. And here, I mean, even if you have a CBDC, but you have a 40% or 50% of inflation, if the regulation does not fully ban stablecoin, people may have quite incentive to adopt stablecoins. And so I think that's why it can create this kind of difficult situation for many countries, that they want to be sure to have to have enough price stability to avoid incentivizing people to shift to dollar-pegged stablecoins before this shift makes their monetary policy less autonomous. So that's why I think it's a major issue. I mean, again, it's not a new issue because it's very like dollarization, which have been discussed and so on, but it makes dollarization much easier to happen because of this potential threat. Again, I mean, all this will depend on how countries react to that through regulation, monetary policy, and CBDC.
Excellent. And I see that Dr. Lucusa also has a question that's related, and I think you already partially answered it, but what is your advice, Eric, to developing countries that have weak institutions because I can see the European Union launching a central bank digital currency as a way to, as a defensive measure, but for many countries that are less developed, it may not even be a feasible response.
Yeah. So it's here, but I think that it's the reason why we use the term multilateralism in the paper, because I think that for this country, there is no other way today than discussing these issues with other countries and with international institutions like the IMF, like the BIS, and I'm a big believer in multilateralism. I think I should not be the only one, but the IMF talk, but I think that's what it means today. I mean, it's what it means today. It's not only about like bilateral loans and so on, but this idea that multilateralism is very important for the payment system, which is something that has been true in history, but has been a bit quite forgotten. I mean, it is coming back really at the forefront of the scene, and is really important. So my advice to this country today would be to be sure to gather with the main trade partner and to think what would be the most efficient payment payment system today to be sure that the trade can be conducted through interoperability through payment system, and then whether CBDC or fast payment system has the best options to be adopted. So it's really that discussion with the main trade partner and with the IMF and BIS are really key for this country. So that's my main advice, which is not easy. It's not a a clear solution, but I think it's starting this discussion is really key because everything can happen very fast with this.
Yeah, I definitely got that message from you when I saw the Citibank chart with only in 5 years already it will be the dominant.
Exactly. I think
it's incredible. That's
so
really surprising.
move fast is really a very clear advice.
Moving fast, yeah. Okay, we have 3 minutes left, and so I'm just gonna group the last two questions I see in the chat, unless somebody would like to come in. But actually, I do see Brendan, so why don't you come in, Brendan, and then apologies, I'm not sure we'll have time to address everything, but go ahead, Brendan.
Hi, thank you. Thanks a lot, Eric, for the presentation. My question is, so you mentioned the right of the reserves as like a way for countries to just insure themselves. And I was wondering how the change in the nature of like the dollar as a reserve currency through the stable coins might actually affect the global safety net and how it works, and especially the rise of like bilateral swap agreements and so on. Do you think that this will have an impact on how like countries will be able to just shed themselves and like multilaterally interact on that? Thank you.
Well, it's a very difficult question. So for the last one, but I mean, I think the global safety net for now is more for for let's say the euro dollar market. So it's more linked to money markets, and for the moment, I mean, stablecoins can take a role in the money market as well, and being used by financial institutions. But this is not, at least in the short term, where the risk is most likely to materialize. So, I think for the moment, I will tend to think that these are issues that are a bit separate, although I might be proven wrong in 2 or 3 years. But that for the moment it's really for the payment system, for the issue of trade invoicing and so on, which is already, I mean, important in a global context, but it's not where the swap line and so on and so on has been operating. Then, I mean, the other way to take your question is to see that it raised one of the big issue, which is who will be the lender of last resort for the stablecoin issuers. Okay, and that's why, I mean, these stablecoins, I mean, they put us in a very situation of very strong uncertainty, because it takes almost like 2 centuries to build proper institution for lender of last resorts for the banking system, and people might even agree that it's not fully solved and completely done. But for stablecoin issuers, I think for the moment we really don't know. Okay, we really don't know what is going to happen if one stablecoin fail, and if there is contagion to the rest of the system. if the contagion, is limited to the US or to other countries. I mean, it's totally possible that a dollar-pegged stablecoin could fail and create contagions to stablecoins, which are an impact in another country, but not in the US, for example, which makes it very, we are not used to this kind of things. I mean, because, when you think about global safety on swap lines, I mean, when the US is doing this swap line, at the same time, they are protecting the dollars and other money market abroad. But for stablecoins, this can be very different.
So we're at the top of the hour, and unfortunately, we have to close on time. But I think it's a good way to end, just as you emphasized, Eric, that there is no historical precedent for this type of strategy, both because it involves these new crypto assets and also because it's driven by private actors instead of official institutions. So this question of the lender of last resort. Let's have a round of applause for our speaker, Professor Helene Monnet. And thank you to everyone who contributed your questions and views today. So I wish everyone a great day, and I'll see you soon for the next seminar. Bye for now.
Thank you. Have a nice day.